Hello, today I'm talking about real estate and I'm facing the question of whether it is better to invest in real estate or in stocks. Okay, so this blog post was inspired by a conversation that I was having with a friend. His name is John, and we meet, I don't know, like every other month or so. We have coffee and we just chat about our life and what give. Okay, so my friend, he told me, guess what, Alain? I bought a rental property. Okay, and my first question was really what property? Was it a condo? Was it a house? Was it a duplex, triplex, whatever? No, my question is it cash flow positive? And in case that you don't know what cash flow positive is, when your revenues are higher than your expenses. So a property where your revenues are higher than your expenses is cash flow positive, and a property where your revenues are less than your expenses is cash flow negative. Okay, so his answer is no. You can't find a cash flow positive in Montreal. And we're talking about Montreal, but this applies to almost every metropolis there is right now in Montreal, in North America. Whether you're talking about Montreal, Toronto, Vancouver, New York, Los Angeles, I don't know, Boston, Philadelphia, Miami, etc., etc. People are bidding up the properties of the houses. They are paying so much that many of them are not cash flow positive, meaning that if you rent those properties, your expenses from the mortgage and the insurance and all these other expenses involved in owning a property, they are higher than the revenues that you get from your rent. Of course, many people think this is something worth pursuing regardless, because they have the hope that the value of that property will increase over time, and they will be compensated for all this cash flow negative that they have been investing into the property. So just to talk about the ups and downs of owning a property, yes, let's start with the commission rate. When I buy a property, usually I pay 3% commission when I'm buying it and 3% commission when I'm selling it. So in total, the commission rate for a roundabout purchase and selling of a property is about 6%. So that means that um, the property value has to go up 6% in order for me to break even, and that's without taking into consideration the time value of money. Of course, as the time passes by, money continue gaining value. So if you just break even on the value of a property, you are still in the hole. So let's say, I don't know, let's say you will have to, considering time value of money, sell a property for 8% more than you bought it just to break even. And I'm just speculating there, but definitely you have to sell it for more than 6% just to break even with the cost of commissions and taxes. There is something called here in my city the welcome tax. That means that when you buy a property, right away you have to pay some taxes to the government on day one, whether you have made any money or not. It's called a welcome tax, and it is what it is. Okay. So another thing to consider when buying a property is liquidity. Buying a property versus stocks. So one of my favorite investment is, well, I think it's not a secret, and 100% invested in the stock market. And one of my favorite investments is the Vanguard Standard and Poor's 500 index. So just to put it in context with real estate, this index today at 1 o'clock, there has been 109,000 transactions in this day, and the day is not even over. So while the price to buy and sell a property, it could take just months to just, I don't know, from the moment I decide to buy a property to, I don't know, getting in touch with a broker, with a real estate agent, making the appointment, seeing it, negotiating, etc., etc. So the liquidity is not comparable. I can sell $1 million worth of stocks in less than a minute. Wow, one a property worth $1 million, it will take me probably 6 months, if anything. So the liquidity, there is no liquidity in real estate. If you want to sell fast, you have to sell at a huge discount. Let's say something in the neighborhood of 20% or so. At that moment, even I will buy a property. Okay, so anyway, so let's go back to then commission. When I buy my Standard & Poor's 500, I could buy $1 million worth of stocks, and my commission is, guess what, $10. $10. Wow. If I buy and sell a property, let's say a $1 million property, the commission is 6%. That's $60,000. That's a huge difference. Anyway, so just for you to consider the commissions on buying and selling a property round trip, $1 million is $60,000 versus $20 right here in the Standard & Poor's 500. Diversification. Okay, so let's continue with that $1 million property. If I buy a $1 million, I don't know, duplex, let's say, all my money is there in just that one property. If something happens, I don't know, let's say there's a fire, that could be very much a possibility right here in Montreal. Well, hopefully I will have insured my property, but whatever. All my money could go up in flames, and then I had to argue with the insurance company in order to get some compensation. Lately, there have been some fires all over Canada. Imagine that your property was in one of these fire high risk areas, and there are insurance companies that are not even covering many of these properties because they are such a high risk. In California, in, I don't know, northern Canada, somewhere. And if you go south, there is the risk of inundation or whatever. So you are putting all your money in this one property, and Mother Nature could just wipe you out. While if I invest in the Standard & Poor's 500, I have, it's called 500 index for a reason. There are 500 companies in there, and this is not the only index that I have. I have another index that covers all the industrialized companies in Europe, and I have another index that covers most of the big companies in Canada. So I feel like I'm widely diversified with my stock market investment. While if I will invest $1 million in a property, I will be running a huge risk. Passive investment. Well, so many people who invest in real estate say that investing in real estate is passive money. Let me tell you, it is not. Investing in real estate is like having a part-time job. You have to, at the very least, you have to be constantly dealing with paperwork, with accountants, with the government, with tenants. If you don't have tenants, if you have someone doing the managing for you, the property managing company, and you have to know whether to trust or not to trust this person or the other person. You have to, if you decide to go for a property manager, you have to spend months trying to find the right one. It is a huge headache. It is not a passive investment to invest in real estate. Sure, once everything is running, the amount of work it could be reduced, but it is not a passive investment. While, let's say I invest in TD Bank, okay? I get my dividend every 3 months, and I don't have to do anything. I don't have to call the president to say, hey, how's it going? Did the janitor show up? Did the teller show up? A machine broke. Was it fixed? No, I don't have to do any of that. All I do is open my broker's account and see my dividend check. And Yes, I said TD Bank, but remember I have 500 companies when I invest in Standard Poor's 500. So all these 500 companies, they are giving me a little bit of dividends every month. So the dividend yield is not that high; it's 1.8. But when you compare it to my friend, for example, who has a negative cash flow, 1.8 is better, much better than having to take out money from my pocket to continue investing in this property. Anyway, so real estate is not a passive investment. It is a part-time job, and it's a part-time job with a lot of responsibility. I was an investor. I got calls that the refrigerator broke, that the washer broke, that the light didn't work, etc., etc. And many times they come at the worst time. There was a time where I had two properties totally unrelated, one from the other one, and both tenants they called me to tell me that they had bed bugs. Okay, and that even though they brought the bed bugs into the property themselves, that was my responsibility as the landlord to make sure that those bed bugs were eliminated. So just to give you an idea of how much of a headache it is to have a rental property. Now, historical returns, I think the historical returns for both real estate and the stock market are positive. I think most people have come up ahead. Of course, if you speculate in the stocks and buy the latest, I don't know, marijuana stocks, I say that because some friends of mine lost lots of money on that. You could lose money. And the same if you buy the wrong property, the wrong condo, with let's say a faulty foundation, you could lose a lot of money. But historically, when you look at the whole segment on average, both sectors have been giving positive returns. I may believe that real estate has provided higher returns than the stock market. But remember, in real estate, you are highly leveraged, number one, and number two is it's a part-time job. You have to work. You have to put your hours into whatever you have to do in order to manage that property. So, although real estate may provide higher return, it's not an apples to apples comparison. It's capital equity plus sweat equity in real estate versus just capital equity in the stock market. Now let's talk about barriers to entry. Well, one of the things, there are two things that are huge barriers to entry in real estate. Number one is that you need a big chunk of capital in order to buy a property, and number two, you need to have a good credit ratings, because even if you have a good chunk of capital, if the bank or your credit is bad, if your bank doesn't give you credit because your credit may be bad, then you have a huge barrier to entry. You may not be able to get into it. Well, if I was going to invest in the stock market, I could start with as little as $100. I can buy, let's say, here if I want one share of the Standard Poor's 500, it will cost me today $107.21 plus the $10 commission or whatever. So the barriers to entry in the stock market are so much lower than the barriers to entry in real estate. Now let's talk about leverage. Real estate works mostly with leverage. Most people get a mortgage whenever they buy a property. They don't buy a property with cash. While most people in the stock market buy their stock market holdings with cash, and they are not leveraged. So let's say a property where you give 20% down payment, that means that you are leveraged 5 times or 4 times. Pardon my math. So that is a huge risk. If your property value goes down a little bit, your losses could be huge. Well, in the stock market, if you buy a stock cash, if I give $100 for my, if I give $107 for my $107 stock, well, I have zero leverage. So I feel a little bit safer in that respect. But also, maybe that's why the returns on real estate are so much higher, is because you have such a huge leverage, 5 times, 10 times. Depending if you have good credit ratings, maybe 100% of the value of the property. Who knows? But yeah, that's something to consider. Now, cash flow. Uh, as we spoke a minute ago, my friend bought a property that is cash flow negative. That means his expenses are bigger than his revenues. That means that he has to continuously take money out of his pocket in order to continue holding this property. While if we hold an index, well, you can see already it is cash flow positive. You are making a little bit of money right from day one. So that's something to consider. Now, this tangible assets. Real estate is a tangible asset. Real estate, if I have a nice condo, I can show it to my girlfriend, I can show it to my parents, I can say, here, I own this property, touch it, smell it, feel it. Well, it doesn't matter how many stocks I have of the Standard & Poor's 500, it is just like digits in my bank account, and I cannot show it to anyone. I cannot brag about it. Well, I can brag about it in the cocktail parties, but it's not the same as showing my house or my rental unit, my triplex. So I admit that for you ego, having a property is a much better bet than having stocks. And of course, it depends on the property. If you have an ugly property in a horrible neighborhood, maybe it's not something to be too proud about. Tax benefits. Both real estate and the stock market have a great tax benefit. Our governments, our society has decided that they would like to tax real estate and stocks at a lower rate than the money that I could earn from working, from my physical labor. So, both of them are treated differently, but if I show in my income statement capital gain from selling a property or capital gain from selling a stock, both of them, the income tax that I will have to pay, the rate will be much lower than if I show the same amount of earning from actual work. So yeah, both of them are quite advantageous. Appreciation potential. Well, that depends also mostly in real estate in the neighborhood where you lucky enough to invest in a property in a neighborhood that is going up in value as opposed to a neighborhood where it's going down in value. So that real estate is local, but in general, both of them appreciation stocks and real estate have a nice appreciation potential. Historically, the return for the Standard & Poor's 500, I don't know, I think it's about 8% per year, which is not bad, not bad. And in real estate, I don't know what's the appreciation potential, and it has so many factors, in particularly the fact that it's leverage. Now, control, when you own, let's say, a condominium, if you decide to change the color of the, I don't know, the faucet or the counters in the kitchen, you have that control. Wow, I cannot go and to my regular bank, TD Bank, where I own shares, and tell the manager that I'd like to change the color of the counters. No, I have zero control over what's going on there. I just know that at the end of the quarter I will receive my dividend check, and that's it. So, but mind you, with control comes responsibilities. If I if I feel inspired by the new Barbie movie and turn everything into pink, and then next year pink is not in fashion anymore, then I made a mistake. So just consider that you have control, but control brings responsibility. So that's about it. It mostly depends on your risk tolerance and how comfortable you feel with one property versus another one. My mother is a real estate investor and she has been holder of some properties for over 20 years. She's cash flow positive and she wouldn't change her position with me any ever. You know, she feels much better having her real estate. I feel much better having my stocks. And you know, so our risk tolerance are different. We are both taking a risk, but you know, our perception of that risk is very different. Also, the investment horizon, it should not be advisable to buy a real estate property today and sell it next year because of all the expenses involved in it. So you have to have, I don't know, maybe a investment horizon of 10 years or longer. But then again, if you have that same investment horizon in when you invest in the stocks, chances are very high that you are going to make lots of money. So that's it. Please let me know in the comments where would you like to invest your money? Would you like to invest it in real estate? Would you like to invest it in stocks? Would you like to do a 50-50? How do you feel about it? I'm eager to know. Send me a message or just, I don't know, let's see, put it right here in a reply. So thank you for watching and talk to you soon. Goodbye.